And we're live.
Hey guys, me one more second here. Get this thing off my screen. Okay. Hey guys, hey there. We're back. Thought you lost us, but we're back. A little break during the holidays, so we wanted to wish you guys a happy New Year. Start off with that, and then today we're going to be talking about a few things going into the new year, and of course we're joined with Evan Einhorn with Modern Home Lending. And I'm Chris Mincola with the Mincola Group over at West USA Realty. So the first thing we want to talk about is obviously we're headed into tax season right now.
Yep.
So perfect time to talk to a loan officer if you're thinking at all in the next 6 to 12 months about buying a house, right, Evan? And
Yep.
can you explain a little bit why that would be important for somebody to do? And of course, you're not a CPA. Still want to talk to the CPA and kind of talk back and forth to you and the CPA about those things, right?
Yeah, for sure. So a couple of different reasons. One is that if you have a tax refund coming, there might be specific things that I can recommend you do to help you get qualified. So I might say, hey, keep it in the bank, or pay off these cards, or keep it in the bank. We're not using it for a down payment, and it's still going to help you as reserves.
Right.
So I know not everyone gets a tax refund by any means, but if you are getting a tax refund, lots of times, people will jump the gun and, do one thing versus another, and I might recommend something else. So if you're thinking about buying 6, 12 months down the road, anytime in the next year, feel free to reach out, and I'm more than happy to say, hey, if you're buying a home, what puts you in the best spot, for a home purchase with your tax refund. On the flip side, another reason would be anyone that is self-employed. I know self-employed, you think you own your own business. There's actually a lot of more 1099 contractors. So if you get paid as a 1099 contractor, or if you're self-employed, and if you're thinking about buying, feel free to reach out. I know CPAs do the best that they can do to write off things, maybe even stretch it, but I can give you a ballpark. Okay. Good to know that, hey, based on your filing of 50,000 of income a year, 100,000 a year, 150, this is what you'll qualify for. So at least you have a good idea down the road, of what you're going to qualify for after you file your taxes as well as before. And at the same time, if you have any mortgage questions, feel free to reach out. If you have any tax questions, not a CPA, but if they're mortgage related, I can answer them. If they're not, I can refer you to the right person. So Chris and I are a great resource. We know a lot of people.
Yep. Yeah. So. And sometimes those write-offs can get you in a little bit of a bind, huh, with qualifying for the house you want.
Yeah, definitely. There's some write-offs. I see it all the time. Someone makes 100,000 business. They write off their income. They only show 40. Honestly, we'll be somewhere in between. So there's certain deductions that we get to add back in. There's also certain deductions like meals and entertainment that actually hurt you even more. So again, case-by-case situation, more than happy to kind of review your specific taxes and go from there.
The meals and entertainment, that's my favorite part. No, I'm just kidding. All right. So the next thing we wanted to talk about was where we are right now on rates and also home prices going into 2019 from 2018 and where we were the year before, right?
Yeah.
So Evan, do you want to talk a little bit about the rates? And,
yeah. So where did home prices go to start?
We're looking at about a 7, according to our ARMLA statistics. That's our multiple listing statistics here in the Valley. To give us the best idea what's going on. It's 7% price increase from November of 2017 to November of 2018. So again, market's pretty strong here in Arizona. Certain areas aren't doing so well around the country, but we're still going strong here.
Mm-hmm.
Obviously,
that's a lot. 7% is quite a bit.
In the spring and summer, obviously, because November, December is kind of hard to gauge, right? So
Yeah. So if you take that 7% price increase, and then so some stats from MBA.org, assuming someone paying regular fees, paying one extra point, so a discount point. So these rates are a little lower because you're paying extra fees. At the end of 2017, the national average interest rate was 3.95. At the end of 2018, it was 4.55. So you saw about a 0.6% increase year over year. On one loan, on a $300,000 loan, that's about $105 a month, which is a good chunk of change for the exact same loan amount. However, when you take into consideration the home price increase of 7% plus the interest rate, you'd be looking at about a $205 difference in monthly payment for the exact same home.
Right.
So a home that was maybe about 280 or so, 279 or so at the beginning of the year, that you'd be paying 3.95, versus at the end of the year, where now you're paying 300,000 for that same home. And now with the higher interest rate, that's what it ends up being. And there's, with the stock market lately, it's been a little weird. So we are expecting rate increases. We don't know how much they'll be. There's some people that are saying, hey, we'll be in the mid to high fives, which would be even a bigger jump than last year, in 2019. So, again, I bought a home with my family, this year, for the sole purpose of, hey, I want to catch it before interest rates go too much higher. So
right, so that's a big difference in what your affordability is and what how much home you can afford. So when we say better to buy now than later, absolutely. Typically what we'd still say that buying, obviously, even in our area, is going to be better than renting overall. Obviously, if you're in some of the outlying areas like Casa Grande, Santan, maybe Buckeye, you may think you're seeing a little bit of discrepancy with that. In certain rental markets of the valley. But here's the thing. Even if you're $100, $200 difference, Evan, with a 7% increase, and over the other years, we saw even more than that. Even if we go into a slight lull with interest rates, which for 2019, we're not really probably not going to see that much of that still. We're looking at, I know builders are increasing their prices about $500 a week. They have been for years. So you may be saving in the best rental area of town $100, $200, but you're losing in equity and possible tax benefits, maybe $400 or $500 in a month. That's conservative.
Right. Yeah. If anyone ever wants a rent-to-own analysis, reach out. We can talk about your specific rent situation, show you what the monthly payments are, and show you what your total wealth is, just to get a full analysis. There's not many people that actually take a deep dive, and we can always play around with the figures of, what if the market doesn't go up? What if the market goes up 2%? What if, what if I buy this home price and have this amount of rent? Like, let's say you're getting a good deal on rent, I can still help you compare that. So.
Yeah, let's say for instance, let's say your landlord raises your rent $50 from one year to the next.
Right.
I've heard 200, 400 in this market from one year to the next. But let's say that's $10,000 in a loan right there. Mm-hmm. And if you have a mortgage, we don't deal with those adjustable rates anymore, right, Evan? So
I have them. But I've only done two, and yeah. With rates so low, I don't recommend it unless you're guaranteed going to be out of the home within 5, 7, 10 years. So.
Right. So when you're buying, your payment doesn't change. You're paying a payment every month anyway. Why not pay it for yourself rather than the landlord? So. Right. Okay. We can get you all the information in the world you want on that, but let's move ahead. So solutions for buying for some people that are running into issues because of interest rates or home prices going up. One of the things I want to talk about is a gift. Can you explain a little bit what that would mean, a gift, as far as maybe money towards a down payment or paying down rates or anything like that, what that would look like?
Yeah, so we definitely, with those price increases, we're definitely seeing a lack of affordability, even in some of the Phoenix area, which is way more affordable than other parts of the country, like California.
Right.
So there's a ton of different things that can help with that. And, if you take a small portion of each of these, it might help you go from 200 to 300,000 or 300,000 to 400,000. But a gift for down payment or closing costs is a great way, if you have access to it, to be able to qualify for more. You can use it, let's say you already have your down payment, but you want to use an extra $3 or $4 grand to get a lower interest rate, lower your payments by $100, effectively maybe increasing your qualification by 25,000. So that's a way right now, if you're relying on down payment assistance, which a lot of people still don't know, you can get your entire down payment covered if you're qualified. If you're relying on that right now, but hey, you can get a down payment as a gift, that'll help lower your interest rate and help you qualify for more. So a gift, I can help determine, hey, what's the best way to use a gift? If you have a family member or someone that's able to give you a couple, few, several thousand, tens of thousands, no matter what the amount is, I could let you know, hey, maybe we should pay off some debt with this. Maybe you should put it more towards down payment. Maybe you should use it towards closing costs. So I can review those different options so you can make an educated decision.
Right. Yeah. Okay. And so the next thing would be a cosigner. What would that look like? Like if you have a parent or maybe a sibling that can help you out a little bit, or somebody who may want to cosign on a loan with you, what does that look like?
Yeah, for no problem. So lots of times, a cosigner, a lot of people think, oh my gosh, my cosigner needs to make a ton of money, and have perfect credit. But, typically to help you, they need to have similar credit to whatever you are. So if you have average credit and your cosigner's average credit, that's fine. Lots of times a cosigner, if they have better credit, sometimes it can help more, but sometimes it actually is more of an income issue. So, if someone has good credit, cosigns for you, let's say they even just make $2,000 a month and they have no debt, they could help you qualify for almost $200,000 more than qualification.
Right.
And that's just off of like $2,000 a month of income, no debt. So obviously we're going to look at the debt and income of the cosigner as well, but that's an option that if for some reason you're not, you can afford the payments because, maybe your husband or wife isn't on the loan, or, someone's living in the house, you have roommates paying you rent, but, they're not going on the loan. If you want to have a cosigner, that is an option, to help increase your qualification. And I'm always happy to talk to cosigners before we actually run credit and go through all that, just to see if they'd be a good fit.
Sure. The next one we have for a solution for the rising rates and prices is, the idea of a starter home and maybe having to move a little bit outside of the area that you exactly want to be in. I know we live in a society where we get what we want when we want it, but there's this concept that used to be known as the starter home, and I want to bring that back in a big way. One of the biggest things with that is you may have to drive a little bit further, but when you're talking about thousands and thousands of dollars in equity that you could be gaining and or saving versus rent, it's a great way to go. And also maybe, you get a little bit smaller house and maybe you actually have to buy a bunk bed. But by doing that, in certain areas of town, you can still get homes under $200,000 or even under, $175,000. Like for instance, a single family detached, a mortgage payment on a $175,000 house right now is going to be right around what, $1,200, Evan? Something like that?
That's a good ballpark, yeah. That obviously depends on a lot of factors, but yeah.
A lot of times I hear people say they want to pay $1,000 a month. I'm like, okay, that's $150,000 house, right? Right around there, give or take a little bit.
Good ballpark.
So, if you want that, it can happen. You just have to, certain parts of Phoenix, certain parts of Buckeye, Santan Valley, Casa Grande, Maricopa. again, you do that for a few years till you get that equity saved up in the house, and then you take that and you move on to your quote unquote dream home, right? That's how it can be done. That's how pretty much most people, and most people don't buy their house and sit in it for 30 years. They just don't do that. I mean, the average now, even with the holdup with the crash and everything, we're looking at what, about 7 to 10 years, maybe max. Evan, wouldn't you say?
As far as requalifying?
No, as far as people moving from one house to the next.
Yeah, even less than that, lots of times, especially in the Phoenix area.
Yeah. So guys, think starter home, think smaller, think outline, think I'll drive a little extra. Okay, that'll solve that problem real quick. We'll make it happen. Paying off debt. So let's talk about paying off $1,000 worth of debt, Evan. What does that do for somebody on their credit cards? Let's say.
So let's say you just pay $1,000 of debt off on your credit cards, which is good in general, anyways. Like, there's good, what people call good debt and bad debt, no matter where you are in the argument, but everyone calls credit card bad debt. So if you pay off $1,000 of credit card, let's say your monthly payments are $50 a month, that'll help increase your qualification for a new home by about $10,000. So if you're at 250, maybe you can go to 260. If you're at 190, maybe you can go to 200. If you have a car, lots of times if you have, an installment loan of some sort, let's say you bought some furniture or whatnot, $3,000, but the payments, $300 a month, like you're financing over 10 months. Sometimes we can exclude that. It's like sometimes we can ignore it if it's almost paid off. But if you get rid of a payment of about $300, that's about $50,000 in qualification.
Right.
So, the car payments of $600-700 a month, they kill you because like a car payment of $650 or so is about will reduce your qualification by about $100,000, which is nuts. Right. I know. Again, these are all ballparks, but just to give you some real figures that you can actually visualize of how much your debt will impact you. But at the same time, like guidelines are pretty loose now. Like if anyone knows about debt to income ratios, like FHA goes up to 57%. So that's pretty high. So definitely feel free to reach out to me and I can, kind of walk you through what debt might help you if you're going to pay that off first versus something else.
Yeah. And, increasing credit was the other one we had here. Obviously that's going to be done by paying down debt, right? That's going to help your credit. Anything else that would help? Obviously, paying things on time. So typically for so someone with a 580 credit score versus an 800, they both make $5,000 a month. The person with the 800 credit score is going to qualify for more. So improving credit, can definitely help you. Is the number one most important thing to helping your credit. And then after that, it's all on a case-to-case basis, but, we can kind of go into details as well. And guys, we do have the down payment assistance programs that gets about half of our people over that hurdle of not having a down payment. Also, we have our new rent-to-own program, which one of the biggest things with that, it's sort of similar qualifications almost to some of the lower DPA scores, right, Evan? It's just 2 to 3 months worth of credit history, worth of work history really cuts out that problem big time, right?
Right. So it, definitely if you're new to a job, new to commissions, new business, etc., but things are going well for you so far and you have a few months in, we as a mortgage broker might not be able to use it right away as far as qualification goes, but the rent to own, they only look at a few months, which is great. So
great. Anything else we didn't cover, Evan, that you think we need to, or?
No, I mean, we're creative. I would say talk to us earlier rather than later. Even if you're not ready to run credit, even if you're not ready to go out shopping for homes today, feel free to reach out. We can give you some really good information to prepare you down the road. The last thing I would want is anyone talking to me like 2-3 months before their lease is up and I tell them to fix 1 or 2 things that might take them a month or 2, and now they have to rent for another year. So yeah.
Super important. Great. All right, guys. And Evan, they can reach you 602-456.
2273. Thank you, Chris.
MonorailLending.com, and you can reach us 480-788-8569 at McCullough.com, and we'll see you guys next week. Thanks for joining us.
Thanks for having me on. See you guys.
Thanks.